Something is happening to the state pension in July 2026 that the government has not written to you about, has not explained on television in plain terms, and has certainly not sent anyone to your door to walk you through. And yet, it affects every single person in this country who is either drawing the state pension right now or expects to draw it within the next 3 years. I want to be direct with you from the very first sentence. Some of what is changing in July works in your favor. A portion of it does not. And one specific element of it is going to catch a very large number of retired people completely off guard, because it looks, on the surface, like good news, and it is only when you read the detail underneath that you realize it is considerably more complicated than the headline suggests. By the time you reach the end of this video, you will know exactly what is changing, which of those changes applies to your specific situation, what you are expected to do in response, and perhaps most importantly, what happens to your money if you do nothing at all and simply wait to see what arrives in your account. I am John Hartley. This is what I do. I take the official language that government departments put out, the legislation, the guidance notes, the technical announcements that sit buried in parliamentary papers that nobody outside of the civil service ever reads, and I translate it into plain English so that ordinary retired people can make sense of what is actually happening to their income. Stay with me on this one because the detail here genuinely matters. Before I take you through the specific changes themselves, I need to give you a piece of background that makes the whole picture considerably clearer. Because the July changes do not exist in isolation. They are the direct consequence of a series of decisions that were made over the course of the last 18 months, and understanding where those decisions came from is what helps you understand why the July changes land the way they do, and who they land on hardest. The state pension in this country operates under something called the triple lock. Most people watching this will have heard that phrase. Fewer people know precisely what it means in practice. The triple lock is a government commitment to increase the state pension each April by whichever of three figures is the highest. The first figure is the rate of inflation measured by the Consumer Prices Index. The second is average earnings growth across the economy. The third is a guaranteed floor of 2.5%, which applies whenever both inflation and earnings growth fall below that level. For the last several years, that mechanism has pushed the state pension upward at a pace that, in any other decade, would have seemed extraordinary. The April 2026 uprating alone added over £400 a year to the full new state pension for those receiving it. And the cumulative effect of those increases over the past 5 years has been to push millions of retired people across a line that most of them never expected to cross during their lifetime. That line is the personal allowance, the threshold below which you do not pay income tax. The full new state pension for the current year now sits at £12,547 annually. The personal allowance, which has been frozen in place by the Treasury and will remain frozen until at least April 2028, sits at £12,570. The gap between those two figures is £23, a little under £2 a month, and every single above inflation increase the triple lock delivers from this point forward pushes more and more state pension recipients over that line and into income tax for the first time in their lives. That is the background. Now let me tell you what July specifically brings. The first change taking effect in July 2026 concerns the payment processing system that the Department for Work and Pensions uses to calculate and distribute state pension payments. This is not a change that has received significant press coverage because it is administrative in nature rather than political. But its practical effect on a meaningful number of pensioners is very real, and it begins the moment the new system goes live. The DWP has been migrating its state pension payment records from a legacy platform that has been in operation, in various forms, since the 1990s, onto a modern digital infrastructure. That migration has been running in phases since early 2024, and the July 2026 phase is the largest and most significant of the entire program. It covers everyone currently receiving the state pension, whose national insurance record contains what the department calls a mixed contribution history. That phrase covers a broader group of people than most pensioners would ever guess. A mixed contribution history, for the purposes of this migration, means anyone whose state pension entitlement is drawn from more than one source within the national insurance system. That includes people who spent part of their working life contracted out of the additional state pension through a workplace or occupational scheme. It includes people who have periods of credited contributions alongside periods of paid contributions. It includes people who claimed home responsibilities protection before 2010, which was the old system for crediting carers and parents who were not in paid employment. and it includes anyone who has periods of self-employment alongside periods of employment within their national insurance record. When you put those categories together, you are describing the contribution history of the overwhelming majority of people who retired before 2016 and a very significant proportion of those who retired after it. This is not a niche group. This is most of the people watching this video. What the migration does in practical terms is recalculate every one of those records using the updated calculation methodology the new system applies. In the majority of cases, that recalculation will produce exactly the same weekly figure the person has been receiving. The system will confirm the current amount, the migration will complete without incident, and the pensioner will notice nothing at all. But in a proportion of cases, the recalculation will produce a different figure, sometimes higher. Sometimes, and this is the part the department is least forthcoming about, lower. The cases where the figure comes out higher are straightforward. The pensioner will receive a letter within 4 to 6 weeks of the migration completing on their record. The letter will explain that a recalculation has identified an underpayment. It will state the corrected weekly amount going forward, and it will confirm whether a backdated lump sum will be paid to cover the period of underpayment. Those cases, where the outcome is money arriving that was not expected, are the ones most people will have heard about in the context of the long-running state pension underpayment corrections the department has been working through. The cases where the figure comes out lower are the ones I want you to pay careful attention to, because the process for those cases is different, the timeline is different, and the consequences of not engaging with it promptly are considerably more serious. If the recalculation on your record produces a figure that is lower than your current weekly payment, the department is required under its own operational guidance to notify you before making any change to the amount that hits your bank account. That notification comes in the form of a letter. The letter will be headed with the words State Pension Recalculation Notice, and it will arrive at the address currently held on your DWP file. Not necessarily the address you currently live at, the address that is on file. If you have moved at any point in the past several years and did not update your details with the department, that letter goes to the old address and you receive nothing. The letter will explain that a review of your national insurance record under the new calculation methodology has identified that your current weekly payment may be higher than the amount your record supports. It will give you a figure. It will give you a deadline, typically 21 days from the date printed on the letter, to respond if you believe the recalculation is incorrect. And it will explain that if no response is received within that window, the adjusted lower amount will take effect from the next scheduled payment date. There are two things about this process that I want you to understand clearly before we go any further. The first is that the recalculation is not always correct. The legacy records the department is migrating from were created over decades, many of them on paper originally, transferred to early computer systems, and migrated again and again as the technology changed. Errors exist in those records. Gaps appear in contribution histories that were contributed to in full. Periods of contracted out employment are sometimes attached to the wrong employer, the wrong dates, or, in a small number of cases, the wrong individual entirely. The fact that the new system has produced a lower figure does not mean the lower figure is right. It means the new system has applied its formula to whatever data exists on file. If that data contains an error, the formula produces a wrong answer, and the wrong answer goes onto your letter. The second thing I want you to understand is that the 21-day window to challenge the recalculation is real and it is firm. Missing that window does not mean you have lost the right to challenge the figure forever, but it does mean that the lower payment amount takes effect while the challenge is being processed, which can take several months, and that any overpayment made during that processing period becomes a debt that the department is entitled to recover. Responding inside the window keeps your payment at its current level while the review runs. Missing the window means your income drops while you wait. So the first action I want you to take as a result of watching this video today is to check that the address currently held on your DWP file matches the address you are actually living at. You can do this online through the government gateway. You can do it by ringing the state pension service on the free phone number I will give you a little later in this video, or you can do it by post. Do it this week. Do not wait to see if a letter arrives. If the address is wrong and the letter goes elsewhere, you will never know the 21-day clock has started running. The second change taking effect in July 2026 is the one that has been discussed more publicly but is still widely misunderstood even among people who consider themselves reasonably well informed about their pension affairs. From July, the method by which HMRC collects income tax from state pensioners who are above the personal allowance is changing. At present, for most people in that position, the tax is collected through the PAYE code applied to any private or workplace pension they receive alongside the state pension. The state pension itself is never paid with tax deducted at source. It arrives in your account as a gross amount every 4 weeks, and the tax liability it creates is settled through the coding notice on the other pension. For people who have both a state pension and a private or workplace pension of reasonable size, that arrangement works adequately. The coding notice reduces the amount of the private pension paid each month, the tax is collected automatically, and at the end of the year the liability is settled without the pensioner needing to do anything. The problem is that a growing number of retired people in this country have a state pension and nothing else, or a state pension and a private pension that is very small. Too small to absorb the full tax liability created by a state pension that has now crossed the personal allowance. For those people, the current system simply does not work. The tax owed cannot be collected through a PAYE code on a pension that barely exists. And so from July 2026, the department is introducing a new process specifically for state pensioners in that position. Under the new arrangement, anyone whose state pension alone or combined with a very small private income creates a tax liability that cannot be fully collected through an existing PAYE code will be moved onto what is being called a state pension tax account. This is a direct billing arrangement. HMRC calculates the annual tax liability on the state pension income. It divides that liability into monthly or quarterly installments depending on the individual circumstances, and it issues a direct payment request to the pensioner asking them to settle each installment by a specified date. The installment amounts are not enormous in most cases. For someone whose state pension is the only income and sits just above the personal allowance, the annual tax liability may be as little as a few £100s. Divided into monthly installments, the figure is manageable. But the critical point is this: it will not collect itself. It will not be deducted automatically from anything. It will arrive as a bill. And for people who have never in their lives received a direct tax bill, who have always had their tax arrangements handled invisibly through PAYE during their working years, the arrival of that first bill is going to be confusing, distressing, and in some cases is going to be ignored because it does not look like anything they have ever received before. I want to be very clear about what happens if that bill is ignored. HMRC does not send a second bill as a gentle reminder and then quietly write off the debt. It issues a penalty notice. The penalty for failing to pay a direct tax installment on time is currently a minimum of £100, regardless of how small the underlying liability is. If the installment remains unpaid for 30 days after the penalty notice, daily interest begins to accrue on the outstanding amount. And if the matter is still unresolved after 90 days, the case is referred to the enforcement team and joins the queue of cases that can result in an officer visiting the property. So the second action I want you to take is to work out as accurately as you can whether your total income for this tax year is above the personal allowance of £12,570. If it is, and if you do not have a private or workplace pension of sufficient size to absorb the tax liability through a PAYE coding notice, you are very likely to receive a state pension tax account letter from HMRC before the end of July. When it arrives, open it immediately, read it carefully, and do not set it to one side on the basis that it looks unfamiliar or that you cannot immediately work out what it is asking you to do. If you are unsure whether you fall into this category, ring the HMRC Income Tax Helpline on 0300 200 3300. The line is open Monday to Friday from 8 in the morning until 6 in the evening. Have your national insurance number to hand when you call. Ask them directly whether your current tax code is sufficient to collect the full liability on your state pension income, and whether you should expect to receive a state pension tax account letter. That single phone call takes under 10 minutes and gives you certainty in either direction. The third change in July 2026 is one that affects a smaller group, but within that group, it has the most significant financial impact of everything I have described today. It concerns people who are currently receiving pension credit alongside their state pension, and specifically those who are receiving the savings credit element of pension credit, which is a component that was closed to new claimants in 2016, but which continues to be paid to people who were already receiving it at that point. Savings credit is a payment made to people who reached state pension age before April 2016 and who saved toward their retirement in some way beyond the basic state pension. It is calculated as a percentage of income above a certain threshold and tapers off as income rises. The maximum amount of savings credit currently payable is £14.48 per week for a single person and £16.20 per week for a couple. From July, the calculation methodology for savings credit is being updated to reflect the changes in the state pension amounts that have taken effect since the last formal review of the savings credit parameters, which was conducted in 2019. The updated calculation will be applied automatically to every current savings credit recipient. For most people, the effect will be modest, a small increase or no change at all. But for a specific subset of recipients, those with income from both the state pension and from a private pension or savings interest that sits within a particular range, the recalculation will reduce the savings credit amount, in some cases to zero. The affected individuals will receive a letter from the Pension Credit Office explaining the revised amount and the date from which it takes effect. The letter will come with a form that allows them to request a mandatory reconsideration if they believe the calculation is wrong. The reason I am covering this here rather than in a separate video is that the people most likely to be affected are also the people most likely to have never heard of savings credit in the first place, to have been receiving it for years without being entirely sure what it is or why it appears on their payment breakdown, and to therefore receive a letter telling them it is being reduced and have no idea whether that reduction is correct, whether they should challenge it, or whether challenging it is even worth the effort. Let me give you the answer to all three of those questions in a single paragraph. The reduction may or may not be correct, because the same data quality issues affecting the July migration affect the savings credit recalculation as well. You should always request a mandatory reconsideration if the amount being removed is more than £3 per week, because the reconsideration process is free, it takes no specialized knowledge to initiate, and it results in a proper review of the calculation rather than simply a confirmation of the computer's original output, and it is absolutely worth the effort because at the maximum rate, savings credit over the course of a year represents over £750, and over the expected remaining lifetime of a pensioner currently in their mid-70s, it represents many thousands of pounds. If you receive a savings credit recalculation letter in July or August of this year, do not file it. Do not assume the department has got it right. Ring the Pension Credit Helpline on 0800 991969. Note the figure they give you as the recalculated amount. Compare it against the figure on your most recent payment statement, and if the difference is more than £3 per week in the wrong direction, ask the helpline operator directly how to initiate a mandatory reconsideration. They are legally required to explain the process to you and to send you the relevant form. Now I want to talk about something that sits underneath all three of these July changes and connects them to each other in a way that most coverage of this topic has completely missed. Every single one of the changes I have described today, the payment system migration, the state pension tax account, and the savings credit recalculation, has one thing in common. Each of them places the burden of action entirely on the pensioner, not on the department, not on HMRC, on you. The migration recalculates your record and sends a letter you may never receive if your address is out of date. The tax account sends a bill you may not recognize as a tax demand if you have never received one before. The savings credit recalculation sends a form that most people will read once, find confusing, and set aside. In every case, the system moves forward on its own schedule. If the pensioner does not engage, the new arrangement takes effect regardless. The money changes. The bill remains unpaid. The savings credit reduces. And the only person who loses anything in any of those scenarios is the person who did not pick up the phone, did not respond to the letter, or did not know the letter had arrived in the first place. I am not describing this to be alarmist. I am describing it because it is the precise and accurate picture of how these systems operate. And the reason most retired people do not have this picture is that nobody with any interest in maintaining the current arrangements has any reason to paint it for them clearly. The one thing that cuts through every single complication I have described today is engagement. Checking that your address is correct. Opening the letters when they arrive. Making the phone call when something does not look right. None of that requires specialist knowledge. None of it requires a financial advisor. It requires time, attention, and the understanding that when it comes to your pension income and your tax position, the system will not look after you unless you look after the system first. Let me bring everything together and give you a clear list of the actions that matter most in the next few weeks. The first thing to do is confirm your address with the DWP. If you are not certain the address they hold on file is the address you are currently living at, ring the State Pension Service on 0800-731-0469. Open Monday to Friday from 8 in the morning until 6 in the evening, free from any UK landline or mobile. Give the operator your name, your date of birth, and your national insurance number and ask them to confirm the correspondence address on your record. If it is wrong, ask them to update it while you are on the call. That takes under 5 minutes. The second thing to do is check your most recent state pension payment statement and confirm the weekly or 4-weekly amount currently showing. Write that figure down somewhere, you will be able to find it again. If a letter arrives in July or August telling you that amount is changing, you will need that figure to compare against whatever the letter states. The third thing to do is work out whether your total annual income from all sources is above £12,570. If it is, and if you have no private pension or a very small one, contact HMRC to ask whether your current tax coding is sufficient to cover the liability on your state pension income. Do this before the end of June so that you have certainty before the new arrangements go live in July. If any of the steps I have described feel complicated, or if you receive a letter in the coming weeks that you are not sure how to interpret, Age UK offers free telephone advice on 0800-678-1602, and Citizens Advice has specialist advisors in branches across the country who deal with exactly these kinds of pension and tax queries every single week without charge. There is one more thing I want to say before we close because it matters beyond the specific changes of July 2026. The pressure on state pension finances in this country is not easing. The personal allowance remains frozen. The triple lock continues to push the state pension upward. Every year that those two things remain true, more pensioners cross into income tax for the first time, and more of the administrative complexity I have described today lands on people who have spent their entire working lives doing everything correctly and who deserve, at the very least, a system that is honest with them about what is happening and why. The reason this channel exists is precisely because that honesty is not coming from the institutions that manage these systems. It is not coming from the department. It is not coming from HMRC. And in most cases, it is not coming from the mainstream press, which covers state pension stories when they are dramatic and ignores them when they are detailed and important but undramatic. What is changing in July 2026 is not dramatic. It is detailed and important. And if you are drawing a state pension or approaching the age at which you will draw one, it has a direct bearing on the money that arrives in your account and the bills that arrive through your letterbox over the course of the next 12 months. Check the address, open the letters, make the calls. And if you know someone drawing a state pension who has not watched this video, send it to them today because the July changes apply to them whether or not they know about them, and knowing about them in advance is the only advantage they are going to get. I am John Hartley, and I will see you in the next video.